5 common errors in self-assessment tax return. Misreporting income. One of the most prevalent errors in self-assessment tax returns is misreporting income. This can occur when taxpayers fail to accurately declare all sources of income, including freelance earnings, rental income, dividends, and interest. Failure to report all your income can lead to penalties and potential legal consequences. How to avoid it: maintain detailed records of all your income sources throughout the tax year. Use the information provided on forms like P60 and P11D as a reference to ensure accurate reporting. Incorrect expense claims. Claiming excessive or inappropriate expenses is another common mistake. While it's essential to claim legitimate business expenses to reduce your tax liability, some taxpayers exaggerate expenses or claim personal costs as business expenses. This can trigger HMRC scrutiny and result in penalties. How to avoid it: familiarize yourself with the HMRC guidelines on deductible expenses. Calculation errors. Mathematical errors in calculations can lead to discrepancies in your tax return. These errors can be in the form of miscalculating income, deductions, or tax credits. Even a simple mistake can result in an incorrect tax liability, which might raise red flags during HMRC's review. How to avoid it: use tax software or work with a qualified accountant to ensure accurate calculations. Double-check all your entries and calculations before submitting your tax return. Missing deadline or incomplete filing. Missing the self-assessment tax return deadline, the 31st of January each year, is more common than you might think. Submitting your return late incurs an automatic penalty, which increases the longer you delay. How to avoid it: mark the tax return deadline on your calendar and set reminders well in advance. Begin the process early to avoid a last-minute rush. If you're having trouble completing your return, consider seeking professional help. Inaccurate classifications and categories. Assigning the wrong classifications or categories to your income and expenses can confuse HMRC and potentially trigger audits. This includes misclassifying different types of income, such as mixing capital gains with regular income, or using incorrect tax codes. How to avoid it: educate yourself on the proper classification of various income sources and expenses. Use the guidance provided by HMRC or consult a tax professional if you are unsure. Be sure to subscribe for the latest tax updates.